Okay, Dr. Payne here again. I wanted to cover at the end of Module 1 and in Chapter 7 um, one of the problems, problem 7.1, and just to give you an illustration of how we're going to use these balance sheet numbers to calculate some of these ratios. So looking at whiteboard, I got problem 7.1 here, and the problem from the text says Hindeline Corporation has $1,312,500 in current assets and $525,000 in current liabilities. Here is how you calculate current ratio. Current ratio is current assets divided by current liabilities. And if you'll remember, I told you that when we talked about the balance sheet that the definition of current is 1 year or one operating cycle, whichever is longer, which most companies have multiple operating cycles within 1 year. So basically, when we talk about current, it's basically 1 year. Very few businesses have an operating cycle longer than 1 year. I usually, when I teach this class face to face, when I talk about an operating cycle that might be longer, I talk about making space shuttles, something that may take more than 1 year to go from cash to inventory to account receivable and back into cash. That's what an operating cycle is. So current is basically 1 year. So if we calculate based on these numbers the current ratio, the current assets divided by the current liabilities, we get a current ratio of 2.5 times. And what that means is that our current assets are able to cover our current liabilities to the tune of 2.5 times. So that's pretty good liquidity. That means that we can pay our bills as they come due. And we can look at the industry averages for other companies in the industry and see if that is similar, or successful businesses, do they have a higher current ratio or a lower current ratio. Of course, we don't want it too high because that means that we're not properly using the monies that the way we could be. We could be investing those additional monies rather than have them lying in the bank ready to pay bills with. So we don't want it to be too high, but we don't want it to be too low. We don't want to run the risk of not being able to pay our bills and becoming insolvent, but we don't want to have extra monies lying around that could be earning more monies for the stockholders. Okay, so that's our current ratio. And then the question is how much they need to raise some money because they want to increase inventory. How much can Hindley's short-term debt or note payable increase without pushing its current ratio below 2.0? So apparently that's a standard that they do not want to go below 2.0 for a current ratio because they're afraid that their investors and creditors will look at them with a little bit of disdain if they think that they're not being solvent enough. So they want to borrow this additional monies to buy inventory, but they don't want to ruin their current ratio. So how much money could they borrow and invest in inventory and still maintain that 2.0? And then the last part of the question was, what will be the firm's quick ratio after they've made that change and gone to the maximum amount of short-term debt? And the quick ratio formula is current assets minus inventory divided by current liabilities. So you take the most liquid of your current assets because inventory would take longer to collect or turn into cash. So we take that out when we calculate a quick ratio. So therefore, we're just leaving cash equivalents, and accounts receivable, which are things that will turn into cash quicker. So we're taking the inventory out. So current assets minus inventory divided by current liabilities is how we calculate a quick ratio. Okay, so to calculate our minimum current ratio, if we take our existing current assets plus the change, that symbol there means the change in note payable. So because we're going to use that money to buy inventory, that's going to increase our current assets. And then it's going to be short-term debt, so it's also going to increase our current liabilities. So we take current liabilities plus the change in note payable. So then we can do that calculation. If that whole thing has got to equal 2.0 in order for us to calculate the maximum change in note payable without changing our current ratio above 2 or below 2.0. Okay, so then we can solve this formula. So we would multiply both sides times this denominator to get rid of the denominator on this side. Multiply that side times the denominator. So 2 times 525,000 gives us 1,050,000, and then 2 times the change in NP equals 2 change in P. And then of course the numerator on this side of the equation, and then we would combine like terms. So we would take the 1,050, subtract it from both sides to get 262,500. Take one of the change in NPs and subtract it from the 2 in change in NPs. So we end up with the change in NP is equal to $262,500. So that's the total amount that they can borrow without lowering their current ratio below 2.0 times. And then the new quick ratio, after we've made the investment, we take the current assets that we had before, 1,312,500 plus the additional borrowings of 262,500 to get our new current assets, subtracting our inventory amount, which we had 375,000 before. We have now invested 262,500 more in inventory. Subtracting that gives us our numerator, divide that by the denominator, which would be the old current liabilities plus the additional borrowings to get 787,500. And so we end up with a quick ratio of 1.19 times. So that means that our current assets without inventory cover our current liabilities to the tune of 1.19 times. So it's running pretty close, right? So if we had to liquidate all of our current assets besides inventory to pay our current liabilities, we'd have very little monies left over. So we're running very close to minimum solvency at that point. So, but that's how you calculate problem 7-1.